So the next thing I kind of wanted to run through is what I call smooth sailing. Haha. Okay. So, um, what makes a smooth transition? A lot of people look at all the aspects of what it takes to get, maybe if they're getting funding for a business, right? They're going through SBA loans or any of that kind of stuff to acquire the business. And I'm guessing a lot of people don't really spend much time thinking about, well, can I get merchant processing, or do I need to even think about merchant processing? And so I'm going to give you guys a little bit of time to kind of run through some of the things that I would suggest taking a look into when it comes to, what to look at from the payments perspective, how that can give you insight into how healthy of a business you're buying, or where there's opportunities in a business that you're buying. Because think about it, if you buy a business that can't take sales, what did you really buy?
Not a cash flowing one.
Yeah, because they may have processing and be okay, but then trying to get new processing for it, if it's not healthy, you just may not be able to do it. So what should you be looking at? So that's what I wanted to run through, is kind of some of the due diligence. I think based on the size of the deal, there's different types of due diligence that I would look at, and I'll share with you guys some of the things to look at to really help evaluate what's good and what's not. So the first thing I'm going to kind of talk through is getting approved or pre-approved. And I would say if you're buying a business that's generating at least $1.2 million a year in revenue, $100,000 a month in sales, fairly consistent, hopefully, but maybe not. It may be seasonal or whatever. And you won't know that just by looking at the financial statements. You won't know that by looking at profit and loss or income statements. You're going to see that as a trend as it happens if you look at processing, though. And so I'm a big fan of kind of looking at, not 3 months, but if you can look at 6 months or even a whole year of processing, you can see what the trend looks like, how sales are generating, if there's seasonality to it, if there's spikes and lulls. I have a client that I'm working with that has a digital fitness product. They went from pretty good, back in January and right in the fitness time, and then COVID hits. All the gyms are closed. Everybody's trying to figure out how to work out at home, and this business just, almost overnight tripled in size. Significant boost. And they're still at a strong run rate even now. So, what's happening? What's the flow of the business? Looking at the processing history over several months gives you a real insight into the trends of what's happening with the business. Is it, did they have some crazy sales? Are they stable? Are they leveling off? Are they declining? Again, those types of things are going to be hidden if you're just looking just at the financial statements.
And you can compare that run rate, so the gross sales, the refunds and chargebacks, to the financials, and double check the accuracy there as well, which is an important part of due diligence.
Right. So I'm a big fan at looking at that. And so you may just look at sales, but I think it's also important to look at other aspects of it, including refunds, returns, and chargebacks. And so those are things that I'm suggest that you'd look at. And if it's a smaller business, honestly, getting approved going on Stripe or an aggregator, PayPal or Stripe, super simple. You're probably not going to have much of an issue because you can get up and running. But what a lot of people don't realize is when you have a larger volume business where they're generating more than 1.2 a year, those things need to look a little bit more closely at financials, because actually aggregators need to do real underwriting at those type of levels. So they are going to be looking at processing history. They are going to look at financials of the company. So you're going to need to actually have that package. And I would even suggest, if you're looking at getting your own merchant account, to actually go through that underwriting process before you make the purchase. Because what a lot of people don't realize is it's not always as simple as just turning it on. So you buy a business, you turn it on, there's a transition. When do you cut over? When's the close date? How do you remove, future refunds and chargebacks and that kind of stuff from the old owner? And how do you assume them onto yourself when you bought a business? And so what most processors do in their contracts, and a lot of people don't know, is in their contracts, you have to, if the ownership changes, they ask you to submit a new contract, a new application, establish your own processing, because they have no way to distinguish. Well, there's several things. They have to know who they're doing business with. There's some know your customer compliance requirements that they have to go through. So they want to know percentage of ownership, who owns it. They want to know, is somebody been on match? Do they have excessive chargebacks? Do they have good business? Do they have high refunds? What's the risk that they're looking at? And everything they're doing is evaluating what's the risk because ultimately the acquirer or the processor of the location holds the risk of all the merchants in their portfolio. So if fines happen, if a company closes, if refunds are getting processed, or a company goes out of business, what's the liability that they're taking? Another thing to look at, I would say, is even like the marketing tactics people have. For example, they'll have long refund policies, and you all know, like, the longer you offer somebody a refund, actually the lower your refund rates are, right? Because consumers will take that product. They're like, I've got 10 days to refund it. Man, that's sitting right on my counter. So when I walk home, I see it and I call to get the refund. I don't forget about it. And they've got 60 days, 90 days, a year, right? They're like, I'll get to that when I do. Whatever, I've got all this time, put it on their counter, forget about it. It's in their way. They move it to a closet, forget about it. 2 years later, they see it and like, I should have refunded that, but that was my fault. I got lazy, So, it sounds silly, but from a bank's perspective or a processor's perspective, when you offer a very long refund policy, they see it as liability, because in essence, it's a term of service. And the way chargebacks actually work is you can file a chargeback for up to 6 months beyond the term of service. So if I bought a annual subscription and I paid for it all up front, and I got 11 months of the service, and then that went out of business, I didn't get what I paid for. And they didn't make whole on it. So I have a legitimate dispute that I could process and get a refund for, at least a partial refund. And so banks get really nervous when you talk about really long refund terms or really long refund policies. So I have a few different strategies to help clients navigate through that I've worked with, and happy to share that with anybody. If they're interested, you can reach out to me after this. You can connect them to me if you want. But I would recommend strongly putting together the package, getting your processing, looking at that, looking at the financials, putting together even a resume, and making sure you can get the processing that you need for the account before even completing the deal. Because if you have that pre-approved, there's no question about it. Otherwise, you kind of get everything, you make the transaction happen. And if you run into a problem, you may not know about it until it's too late. And so it's just not a great situation to be in.
Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller?